Hello, welcome to my video. Today we're going to talk about stock warrants. A warrant is a security that entitles the holder to buy the underlying stock of the issuing company at a fixed price called exercise price until the expiry date. This requires a bit to break down. The stock that you are buying is an asset for that company that is selling to raise money, hence the expiry date. And because the particular stock you are buying has that expiry date, they lock your buying price of said stock, regardless of what the actual stock price is. I'm going to give a very simple example of this. Say company A's stock price is $50 and they wanted to raise money to buy something for their company. So what do? They issue a warrant stock selling that warrant stock at $50 for 6 months. So if you manage to buy into the warrant stock, then you are buying in at a locked price of $50 per share for that stock for that period of time, regardless of it going up or down during the 6-month period. If the stock goes up to say $55 within the 6 months period and you sell it, you earn money. You must sell that stock within the 6 months time frame or it expires and you lose your money. In many ways, a stock warrant is like a stock option, which also gives the holder the right to buy shares at a fixed price during a defined time period. If the stock never rises above the strike price, warrants expire worthless. Warrants are sold by companies as a way to raise capital. Although a company would sell stock to raise money, the Securities and Exchange Commission regulates the number of shares a company is allowed to issue. Why do investors buy warrants? Warrants give the investor an opportunity for higher returns, but at a higher risk. However, the maximum an investor can lose is the original investment. It is easy to purchase warrants and they are also regularly traded on the equity market. They are very liquid, allowing the buyer to easily sell it. When a warrant is exercised, the stock that is purchased upon exercising the warrant need to be issued new by the company. If you own common stock in a company that already has warrants outstanding, which means the expiry date hasn't passed yet, any exercise of the warrants will increase the number of outstanding shares, thereby diluting the existing shareholders. Aurora has issued many warrant stocks over the past 2 years because if they didn't, they would not be where they are today. So looking back at Aurora's capital raising, Canaccord Company has been purchasing warrants from Aurora since 2016. On September 2016, Aurora announced that it has entered into an agreement with Canaccord Genuity Corp, pursuant to which the company issued on a private $15 million following the closing of the offering and prior to the maturity date. Aurora Cannabis announced another capital raise, engaging Canaccord Genuity to help it raise up to $25 million through a private placement of 10% convertible notes that mature in 2 years and that are convertible into shares at $2. If the shares of ACB trade at or above $3 for 10 consecutive days, the company would be able to force conversion. In October 2016, the company closed a $15 million convertible note offering. As part of the current offering, the holders will be converting $10 million of those convertible notes into 8,695,000 shares. On January 24, 2017, Aurora announced that it has entered into an agreement with a syndicate of underwriters led by Canaccord Genuity Corp, pursuant to which the underwriters have agreed to purchase, on a bought deal, private placement basis, 22,500,000 shares of the company at a price of $2.25 per unit for aggregate gross proceeds to Aurora of $50,625,000 for a period of 2 years following the closing date of the offering at an exercise price of $3 per warrant share, subject to adjustment in certain events. On October 10, 2017, Aurora announced that it has entered into an agreement with Canaccord Genuity Corp, pursuant to which the underwriters have agreed to purchase on a bought deal basis 16,700,000 shares of the company at a price of $3 per unit for aggregate gross proceeds to Aurora of $50,100,000. Each unit will be comprised of 1 common share of the company and 1 common share purchase warrant. Each warrant will be exercisable to acquire 1 common share for a period of 3 years following the closing date of the offering at an exercise price of $4 per warrant share, subject to adjustment in certain events. On November 16, 2017, Aurora announced that it has entered into an agreement with Canaccord Genuity Corp to raise $100 million. Beginning on the date that is 4 months plus 1 day following the closing date, the company may force the conversion of all of the principal amount of the then outstanding debentures at the conversion price on not less than 30 days prior written notice should the daily volume weighted average trading price of the common shares be greater than $9 for any 10 consecutive trading days. For those that don't know what a debentures is, it is an unsecured loan certificate issued by a company backed by a general credit rather than by specified assets. All of this capital raising will cause the amount of shares in Aurora Cannabis to go up dramatically. At the end of the day, if management does not mess up how they spend the cash, the stock prices will go up dramatically. Aurora at the moment has around 400 million total company shares. One day they might have a billion's worth of shares. If you look at Facebook, they have 2.4 billion shares and their stock constantly moves on an upward trend. As long as Aurora achieves their goal of becoming a globally dominant company in the next 5 years, we might see a $100 share price. As an investor, this is great news that the company has a huge sum of capital to work with. It seems to me like Canaccord Genuity is recycling the money that they are getting from Aurora back into the company. Thank you for watching. I hope you've learned something new. Subscribe for future updates. Have a happy holidays, Merry Christmas, and Happy New Year.